Hello and welcome to Fireside with VC. My name is Andrew Romans, and I'm very excited to have someone on the podcast. Not a lot of people claim to be big angel investors, but Forbes magazine calls Fabrice Grinda the number one angel investor in the world. Fabrice, thank you for joining the podcast.
Thank you for having me.
It's good to see you. So you were just telling me you normally are in New York City and you'll be there next week, but where are you working from home at the moment?
So right now I'm in Turks and Caicos. I'm not sure home is the proper proper definition or description, but I rented an Airbnb and spending the week here, and it's great to be working from. And frankly, I actually have a life setup where I usually have this hybrid lifestyle anyway, even in non-COVID times, where I spend like a month in New York, where it's socially, artistically, intellectually super intense, but if you're not thinking. And then I spend a month in a more quiet place. I'm actually still working, obviously, in those places. I'm still doing Zoom calls and emails, etc. But by virtue of not being socially and professionally super busy all the time, I take the time to reflect, to write, to read, to think. And this year, instead of being, a month on, a month off, has really been mostly not in major cities and mostly on the reflective side. And I've actually used that opportunity to write a lot more, to launch my own streaming show, playing with unicorns on venture and startups every Thursday at noon, and to redesign my blog and to do all the things that I've really meant to do, but they were neither urgent or super high priority, and so they were in that to-do list of things that never gets done.
Well, I think we've seen that with our own portfolio companies too, and even large corporates and everybody, that COVID is an accelerant on digitizing whatever your strategy was. I was talking for years about doing this, interviewing you and everybody else that I think is worthy to listen to in Silicon Valley Bank studio in Silicon Valley. And, I just never got to it. So I think it's good that we're making those changes. But so let me give you a quick introduction, and then I'm going to have you tell us about your history more and what you're doing today. So Fabrice Grinda is the co-head of FJ Labs. Prior to becoming a prolific investor, he was CEO of OLX, which was classified in emerging markets. Very big hit. Before that, he founded a company and was CEO of Zingy, which he led to 200 million in annual revenues, profitable within 4 years. So that's somebody you could take some advice from on how to do that. It's got a lot of experience in emerging markets and even in investing outside of the core Silicon Valley, New York, London, even Berlin, Paris location. So a lot of interesting experience there. He's invested $284 million. So beyond his exits, he's invested $284 million into 571 companies, which yielded 193 exits. And the drumroll IRR was
62% a year over the last 22 years, probably net realized. So including all the losses, and it's cash on cash realized return, which is probably, in the top 0.1% of all VCs ever.
Yeah. So it's quite interesting. And some of these include Alibaba. I mean, there's a couple well-known names that would make up for, probably a lot of bad bets. But Fabrice, why don't I shut up and why don't you tell us about, we could talk about anything and everything you want, but I'm curious to hear this sort of anti-VC mentality of, you invest over 2 Zoom meetings, or you take board seats, or you don't, or you follow, you lead. Why don't you give us the basic thesis of how you're different and what you're doing?
I'll get to this thesis in a second, but it really, comes from what I was doing as an angel. Right? I was always an investor while I was an entrepreneur, and because by virtue of being a visible consumer-facing internet CEO, a lot of other people come and approach you and ask for money and advice. And early on, I didn't really have money to give them, but ultimately, as I had exits, started investing in them. But the thing is, if you're a tech CEO, you're super busy, right? So as I was running OLX, it's 5,000 employees, 30 countries, 350 million uniques a month. But I'm like, I actually like helping other entrepreneurs. I like investing in them. I like putting my money where my mouth is. And I think I actually, if I can articulate my thinking and my processes, it makes me a better entrepreneur. And at the same time, if I understand that the latest trends of the market is very useful. It's very useful to me as a founder to see what other people are thinking and doing, et cetera. But that said, I can't take too much time. And so while I was a founder, I was like, hey, if I want to be an angel investor, I'm only going to do it in categories I understand innately because I'm operating in them. So let's focus only on marketplaces. And I can't be spending that much time doing analysis. So let's create a strategy and a set of heuristics that allows me to evaluate companies really quickly. At that time, is one meeting. In the meeting, I'd say I'm in, I'm not, and why. Now,
Really?
the and it worked really well. Now, it allowed me to iterate and get up with the. Also, another thing is, well, a lot of moving parts here, but like first of all, having a specificity or a focus is super helpful in the sense that it leads to better branding. So you're known as the marketplace entrepreneur, so other or investors, so other people, you start seeing all the deals. Because you see all the deals, you get to refine your heuristics, and you get so many at bats to become a smarter decision maker on the category. And then which in turn leads to better deal flow and improving the quality of the deal. So there's like this virtuous circle or network effects in having a specificity. Now, in terms of when I sold OLX, it was 2013, already made over 100 investments, very successful. I've been building companies. I'm like, okay, I like building companies, I like investing in companies. Let's create a structure that allows me to do both things. And that's what ultimately FJ Labs became. It's a hybrid venture fund and startup studio. Didn't really start in 2013. I mean, the genesis of it, the formal creation was 2016, but really the genesis was 2013. And at that point in time, I'm like, okay, what is it that I liked as an entrepreneur from interacting with VCs? What is it that I didn't like? And I realized that very often the VCs I would be talking to would use time as a means of due diligence, and they also didn't seem to have like the conviction behind their beliefs. I would meet them and it would go really well, but then I wouldn't hear from them, or it would be another meeting 3 weeks later, another meeting 3 weeks later, and like from the first meeting to the final partner meeting to term sheet, it would be 4 months, 6 months, and those processes didn't make any sense to me. Now I understand why the VCs do it. If they don't like you, they still rather not pass because they would like to keep the optionality of changing their mind in the future. And if someone tells you, oh, this month I'm on 100K, next month I'm on 125, I'm on that for 150, waiting 3 months, of course, gives you the time to see if they deliver on what they promise. But that said, as an entrepreneur and as a founder, the uncertainty of when you're going to be, whether or not they're interested, and the funding you're going to get is actually painful. And so I'm like, I want to do the opposite of that. I want to be able to decide very quickly, and by virtue of operating in a category which I understand, I think I can actually evaluate companies very quickly. I'm more than happy to share my evaluation criteria. But now what's changed from before used to be one meeting and we would decide. Now we get 100 deals a week. So we need to go through the deal flow, and many of them were out of scope, et cetera. So the first call is taken by another member of the team for the most part, and then I'll take a second call for the ones that seem interesting. And on these 2 1-hour calls over a 1 week period, we'll decide if we're in or not. And most often, I will tell the founder on the call whether we invest or not and why, with full transparency. Like if I think the valuation is too high, or if I think the pitch is not really good, or if the transparency on the reasoning and what would need to change for me to change my mind.
Yeah,
Because of course we would mostly
I
say no.
think I think a lot of VCs that were not operators may not actually have the understanding and compassion to realize that being very Japanese polite, smiling, even if you're telling them horrible news,
Yeah.
that's not helpful. And in fact, it's destroying value that the only currency that unfunded entrepreneur has is time. So
Yeah.
to play games with, I want the optionality of coming back once Sequoia and everybody else is in, is quite damaging to the entrepreneur's actual time, on doing that. So tell us a little bit about, so historically and today and moving into the future, what is your geographical focus or open area? I think that's not typical either.
The I never set boundaries of where we were looking to do deals, but I thought through, okay, where do the excess come from? Where is value being created? Now, by virtue of being so visible in the emerging markets through OLX, I mean, OLX is 350 million uniques. It's the largest classified site in Russia and Ukraine, Romania, all of Eastern Europe, and Brazil, and all of Latin America, and India, and Pakistan. I started getting a lot of deal flow in these geographies. And as I saw the ecosystems grow up there, I started investing there as well. Now, our geographic allocation is still 70% US. Most of what we do is business model innovation in the US, and we've done really well here. Then 20% Western Europe and the Nordics, and these days about 10% Brazil and India. And we're only now venturing into slightly smaller markets, but where the ecosystems are growing up. So Pakistan, Mexico, Colombia, Nigeria, Kenya, and South Africa. We used to invest in Turkey and Russia as well, but both countries, the political decisions made by the leaders, Erdogan and Putin, have created a negative macro environment, which we felt would create a negative micro environment for startups to be in, to operate in, and to get exits in. And so we mostly have shied away from these two geos, even though we used to be rather active in them. The one commonality in the countries that are not Western Europe, the US, and the Nordics is that they're typically large. In Brazil, where you have a population of 210 million people that are reasonably wealthy, you have a fully blown ecosystem where you can get everything from seed funding to A and Bs to later stage funding. The issue with the smaller markets, like Chile, where we don't really operate, is that even though you can get the seed funding, and if you do break out, the Tiger Globals of the world will find you once you're at 100 million in revenues, 100 million in value. The problem is that AB, there's really a Series A B crunch in the smaller markets, in the emerging markets, and that's not where we play, and so we can't help you there. And so the main recommendation for the founders there is, move to Brazil or the US or whatever, or target the larger markets, not the domestic markets. And now there's been a few breakouts, like in Colombia, you've had Rappi becomes so big by going across Latin America in a category that's large enough that now there's an ecosystem emerging there. But for the most part, we've done larger markets in emerging markets, which is why it's like India, Brazil, Nigeria, Pakistan, where hundreds of millions of people in the countries where you can actually justify building larger companies.
What's your perception of Southeast Asia? Like
So Indonesia,
Singapore, Malaysia, Indonesia, Vietnam,
yeah.
Thailand, Philippines.
Yeah, of these, Indonesia is probably the most interesting. It's the largest, and from a population perspective, and there's a number of companies that are really emerging, and obviously OLX is a big operator there. We also bought the largest local e-commerce and marketplace. The issue, the reason we've shied away is, in a country like the U.S., the winner is the one who raises the most money, who's the best operator, and it's usually the best teams. And in these markets, often there's a regulatory component of the people that are better connected. So there are a number of families that own essentially big chunks of the economy. And if you're not politically aligned with them somehow, perhaps your license gets revoked. So we've considered like investing in a Expedia for Indonesia many, many years ago. The problem is the team that was probably the best to win was not the team that the government granted the license to operate. And the fact that you even need a good license to operate, to me, is annoying. And because we're not on the ground and we don't actually know the nuances, we don't know who's in or who's out, et cetera, we've been more careful. Now, as these countries modernize, corruption becomes less of an issue, we'll revisit. And we actually have looked at deals in categories that are less regulated, but we're more careful in these geos. And in a few categories like food delivery, we totally look at it. I mean, food delivery is a large enough category that it would work in every country. So the delivery hero equivalent models in the world, the Gojeks of the world would look at as well. But most other categories, we'd be more careful of.
Okay. And you already touched on it with your focus on exchanges, which something you understand a lot, marketplaces, which you understand really well. But when you're investing in so many companies, it's such a one call, two call, boom. How do you add value to the startup after, at least you didn't waste their time?
The way we add value is threefold, and it kind of depends on the stage you're at. If you're really early, because I've seen so many companies try to build liquidity, your fundamental questions are like, do you serve the supply or the demand? What should your rate be? Should it be 1%, 5%, 20%, 50%? I can help you think through how to measure elasticity of supply and demand, what the correct business model is, et cetera. So that's for the pre-seed companies. And only a low percentage of the companies we talk to actually want this help or need it. Most of them are a little bit later stage than that. The companies that are later, beyond the fact that we're super transparent what we think they're doing well, what we think they're not doing well, and thoughtful, the main value add for us is we help them fundraise. So because we're not leading, we're not pricing, we're not taking board seats, we don't have ownership requirements. So we play nice with all the VCs in the world. So every 8 weeks or so, we sit down with 100 of the top VCs in the world, and that's like across every stage, across every industry, across every geography. So it could be, whatever the first round capitals, or Slow, or Floodgate, or Uncork in the US at seed. It'll be like whatever Greylock, Sequoia, Andreessen, Bessemer, Gel Catalyst. I mean, every name in the A and the B ranks in the US. It'll be all the relevant players all around the world, and we share deal flow. And they will invite us to co-invest with them in the marketplaces they're looking at the later stages because they want a perspective. But perhaps more importantly for them, all of our C deals need an A, all of our A deals need a B, all of our B deals need a C. And so we vet extraordinarily high quality deal flow for them that's completely differentiated. So they love it. Now the founders love it because they get funded. So once we invest, we work with the founders about 6 months before they want to go out to the next raise. On their deck, we walk through and we map out what are the correct VCs for them, and we make the intros. Now, in terms of helping beyond that, it's really whatever the founder, it's on an as demanded basis. So we don't actually reach out and say, what can we do to help you? It's if you come and have a specific request, we will always grant it. And by the way, if we think you're not ready for a raise or your metrics don't justify an intro to Sequoia, we'll also tell you that. So
Right.
we don't just send all the companies, we actually send the ones we think are the best for each VC, having eliminated conflicts and only sending them at the right stage and the right terms. And so we'll mostly help fundraising. We have a head of platform, but our platform team, of course, we don't have, half the capital that's deployed in the company is my partner and mine. We don't really have enough assets under management to have a fee structure where we can have like headhunters, et cetera. And so other people will focus on recruiting. We're like, you know what? We're going to almost exclusively do fundraising. And
Yeah.
because we have these relationships, we can help you fundraise. And it's a massive time saver for the founders, and they love it.
Yeah. It makes sense. And with just, you said half the money in the fund is you and your co-founder Jose. What?
Yeah.
So,
It's a bit less than that. It's probably 40%. To date, we've deployed 270, and maybe 120 of that is our money.
okay. And what are the LPs look like? Without saying the name of an LP, are they
Sure.
founders that you backed in the past? Are they pension funds, endowments, insurance companies, or is it the usual suspects, or is it more the unusual suspects?
Oh, completely unusual suspects, and completely unusual suspects because I never set out to build a venture fund. In 2013, in fact, when I started building or holding companies that was to invest in companies and build companies, we considered like, we talked to a bunch of normal, usual suspects about whether or not they'd be interested in investing in what we're doing, and the answer was no. I mean, the idea that we would do limited due diligence, decide so quickly in every geography, in every category, in every industry, even though it's specific by business model, that it was not something that they could get comfortable with. Even though we'd been very successful angel investors, they didn't give us the credit I think that we deserved as venture capitalists. And I understand that venture capitalists typically have a very different approach, but in this case, we're doing the exact same thing as larger scale investors than we were as angels. So I think that it made sense, or the credit we should have been given, but they weren't comfortable with the approach. And so we're like, okay, it's fine. We're happy to invest our own money. But what happened is so the first 3 years, we didn't raise any external capital. All the traditional like pension funds, the university endowments were like, no, this is crazy and too scary, despite the returns. It's not for us. And, we invest at every stage, in every geography, in every industry, et cetera. But a few years in, a number of, I'd say, strategics who like marketplaces, who either are marketplaces themselves and they were looking for companies they could eventually perhaps acquire, and other strategics from outside of the US were like, hey, we own marketplaces, or we run marketplaces, or we be disruptive on marketplaces, and seeing what's happening in the US, what the trends in the US are, and where the world is heading is really useful to us, either to adapt these ideas or acquire some of the companies, et cetera. And so all of a sudden, we, little by little, I mean, our first LP was one company, Telenor, which is
Oh
the
yeah.
largest telco in Norway, and they're very big operators in mostly in Southeast Asia, actually. To your earlier point, they own the largest mobile operator in Myanmar, they're in Pakistan, they're in Malaysia, et cetera. And so I'd been working with them for many years because they had done a JV with my biggest competitor when I was running OLX to attack us in the emerging markets, a company called Schibsted. And later we fought a big war. Schibsted, so they were 50-50. Schibsted and us, we bought them. We merged 51 for us, 49 for them. At that point, Telenor at 25%. And as part of an ultimate exit deal, they ended up with the ownership of the core classified assets and marketplaces in Southeast Asia, in Malaysia and Myanmar, and a lot of these countries. And so they were also found themselves operators of marketplaces, and they're like, hey, we'd love to understand what's going on in the US and perhaps bring some of the ideas or adapt some of the ideas for their markets. And so they became our sole LP for Fund One with external capital,
Oh, okay.
giving us 50 million. That was in 2016. We deployed the capital in 2016 and 2017, and 2018. Other strategics started saying, hey, we'd like to have the same deal. We'd like the same insights, like what is going on in prop tech, what's going on in recruiting, what's going on in cars or whatever. And so all of a sudden, a number of other strategics and or family offices linked to companies that were being disrupted by marketplaces started investing. So now Fund 2 is a $175 million fund, again, of external capital. So in both cases, I'm not including our capital that's on top of that, and obviously it's a large percentage of the capital we deploy. And so Fund 2 is 175 million, less than 25 LPs, and essentially all either family offices of companies being disrupted by tech and by marketplaces specifically, and or people interested in acquiring marketplaces. I don't know which names I'm allowed to share or not. Telenor, of course, is again a large LP.
Yeah. Well, I think you may know, I wrote a book called Masters of Corporate Venture Capital, and I've really studied their unique interests, and the business intelligence they get, is often more interesting for them. If you're seeing everything in a category that's impacting their business, an entrepreneur coming into your office today on that Zoom call with you, that's a fuzzy thumbnail of what the future looks like. Wait, I just lost the audio.
No.
Okay.
I was making comments so we don't have people walking behind me all the time.
Oh, okay. No, that's cool. Yeah. Yeah, no, but I think that from the corporate perspective, to see the startups that are coming in and pitching you and me today gives them like a thumbnail view into what the future is going to look like. And they don't want to jump off of every bridge. If someone says, hey, jump off this bridge and do this, that you're also observing over time what is working, what is not working.
Absolutely. They're interested in seeing the flow, but obviously they don't do anything until something has reached massive scale.
Yeah. So I think that the free business intelligence with the prospect of a 62% IRR on it makes it like zero cost R&D. You could spend a lot of money on McKinsey where you spend some time, or you could spend time on FJ Labs, which is probably giving you better optics into these areas that you totally command.
Yeah,
Fabrice,
I mean, look, it's not ideal because these are not investors that, their strategies may change, their willingness to be in here. Like, so I would actually like to have the type capital that's committed for like 3, 4, 5 funds. Also, we're still under investing, right? Like, so I back tested with the strategy we use, how much could we deploy every year? It's probably 100 million, 125 million a year, and we're deploying 50, right? Like, so we could probably be a 350 fund instead of being a 175 fund, but it is what it is.
So with it being what it is, what is your portfolio construction and check size? I know you've got pretty specific understanding of what you've done historically. I usually hear VCs tell you what they're going to do. They don't tell you what they did.
So first of all, there's no explicit desired portfolio construction. I didn't start the saying, oh, I intend to invest in blah number of deals per year at blah stage, et cetera. The philosophy we've always had is if we see deals we like, we invest. If we don't see deals we don't like, we don't invest. And let the cards fall where they may. And so it leads to a fair amount of variability and because we're look at every stage and every geography, it leaves a fair amount of variability year on year. Some years we'll do 100 deals, some years we'll do 150 deals, some years we'll do 75 deals, some years we'll do mostly. We used to do only seed, seed extension, and A, and then some occasional later stage. But when every fund in the world started going later stage, I'm like, we should be moving the other direction. So we added pre-seed starting in February 2018. That we hold that a higher standard or bar. So if we look at our historically what we've done. So again, so there's no I'm getting closer because I'm probably going to share my screen. There's no explicit portfolio construction in terms of exactly what the fund should look like, how many deals should do, et cetera. And by the way, as a result of that, and because of our very specific follow-on strategy, we follow on for whatever fund we happen to be in at this point in time. So we don't actually reserve any capital for follow-on. We will evaluate follow-ons exactly the same way as we're evaluating a new investment, as though we were not investors, but knowing what we know now, would we want to invest or not at the deal terms presented? And if yes, we invest. If not, no. And if yes, and the current fund is out of money, the new fund will invest. And so we also tell LPs invest in every fund.
And by the way, can we stop on that for a second, Fabrice? I find it odd that I mean, I understand why. Most VCs conventional will say, if we funded a company out of Fund 18, we're not going to put any money into that same company from Fund 19. I'm kind of joking when I say who we're talking about, who's on their 18th fund. But I think that their logic is that I don't want to throw good money after bad, meaning I don't want to fund a sinking ship to prop up my carry and performance of my other one. I should basically let it die. From our perspective, we've come up with policies that say, if the company's performing well, it's not a lifeline. This should be a reward of re-upping in my next fund. That if we took a risk on a bunch of companies and now we're doubling down on our winners within that fund, we should be able to double down on their winners in that. I mean, that's part of the investment thesis is our latest fund has access to the winners of my first two funds. To divorce that huge, asset that we have, it's just throwing out part of the reason why you should invest in the fund.
Exactly. You need to trust us, obviously, to be objective. And we're like, look, we're going to evaluate every deal when there's a follow-on objectively. And if we think it's worth investing, we'll invest. If we don't think it's worth investing, we won't invest. And we're not, doing like value protection by writing pro ratas. And by the way, we don't, on average, we don't do our follow-on. We only follow on 25% of the cases for a number of reasons. The main reason the companies are doing well, sometimes we feel are overpriced. So we're actually not doubling down on our winner, on our the very best companies, right, as most VCs are doing, because we don't think on a risk-adjusted basis it makes sense. And also because the products are too big, right? It's kind of like the capital constraints I mentioned earlier, where one of our companies is doing so well. I think our pro-rata was like 50 million. Our entire fund the entire amount of capital we deploy per year is 50 million. So it's like it's 500K and 100 deals, right? We're not going to put all of it in one company, and so often we can't do it. But that's okay.
But Fabrice, maybe what you should do is raise another vehicle, and I'm sure you've thought of this. Raise a vehicle that says, look, our core fund, when we're investing in pre-seed, seed, late seed, seed extension, pre-A stuff, these are really where the big hits are going to come from. This is where you get a 100x return, a 50x return. I don't know what you made in Alibaba, but I'm sure it was phenomenal. Whereas we're now getting a different vehicle that says we do have pro ratas, we do have optics. We knew this founder at his third, fifth company before doing this latest one. So we're going to be seeking to make a 3x return, or maybe if we get lucky, a 5x, 6x, sometimes a 1x. And it's very unlikely to lose money in some of those deals. It's illegal to say that to a prospective LP, but it might make sense to have a separate vehicle that's got a different culture, different set of rules, and you're putting good money into those deals.
So funny you should mention that. I think for fun, we still have like a year worth of deploying a fund 2. I mean, so fund 3, I think we're doing exactly that. I think we're going to do pre-seed to A funds, and then an archangel fund where it'll be either the late stage opportunities we see or the very best companies that we're following on from the prior funds that we'll follow on here, because the returns profiles are different, and we don't currently have enough capital to invest in those very best companies. And so I don't know exactly what the allocation split is. I mean, ideally in the future, I think I'd like to deploy 350. I have a 350 fund, so maybe I don't know if it's 175, 175, or it's 150, 200, something in that range. It might be 125, 175. But I think your idea makes a lot of sense, and I think it's definitely the direction we're heading in. And of course, presenting it that the returns profiles are going to be different. So actually, let me share with you a few things.
Yeah, sure. I think I'm
Nope,
gonna make you the host, right?
and by the way, for what I just said, I think it's 95% probably the direction we're going in. We haven't decided to do it exactly yet, but I think so. So portfolio construction to date, 63% pre-seed seed, 28% A and B, 9% later stage, and I think in the future I'll break that down better. We're 58% US and Canada from the deals, 25% Europe, 6% Brazil, 2% India, 9% other. And check sizes, and I'll do it in the US, we're at 220K pre-seed, 390K seed, 620K A, 750K B, and 1.32 million C. And the logic for these numbers is, first of all, we want to focus more on the earlier stage than the later stage, but we never want to compete for allocation with the lead. So these days, let's say a typical seed deal is a 3 million Rand, where the lead is writing a 1.5 or $2 million check. By taking 390, we look like a big angel, and we're not competing with them for the allocation, and so they see us as a friend.
When you're doing pre-seed at 220,000 US, what's the size of that round typically?
Yeah, so in pre-seed we may sometimes be the largest check, where it's $1 million round, and it's mostly other angels. There are not many pre-seed funds, by the way. I mean, there's Amplified, there's A4, there's a few of them, but they're not very many. Most of the pre-seed rounds we see are like 20 angels writing 50K checks a pop. But even though we may be the largest check, we make it very clear, like, look, don't see this as signaling. This is not as though we don't consider ourselves a lead. We just consider ourselves as the large angel. Yeah, we're not going to take a board seat, etc.
Don't see it as negative signaling if you don't follow on. Is that what you mean by signaling?
Well, more in the other direction. If we commit to pre-seed check to 20 and $1 million Rand, I don't want all the other angels to think, oh, these guys are leading, they're doing extensive due diligence, and just pile on top of them. We're not typically. We don't write term sheets. We join term sheets that are existing. We don't set prices. We're price takers, this is the one case where we may very well be the biggest check, and also the pre-seed funds write 250K to 500K checks, so our checks are reasonably large there. That's the one category, but they also don't see us as competition. There's so little capital in pre-seed from traditional investors. They're happy to have us on board.
And what do you see typical for valuations? Have you seen a change in valuations with COVID, or good companies have a big queue of investors that want to be backing them? What are you seeing in valuations in the US? And then it'd be really interesting to compare that to your global perspective. Like, sure, the same company with, say, a 6 or 8 million pre in Silicon Valley has got a 2 million pre in Sao Paulo.
Let me reshare my screen for a quick
second. Share your
second.
screen again, yeah.
Yeah, I'll do it again. So first of all, there is a norm or a range of expectations for what valuations look like, and those are reasonably well defined. Let's see if I have one that's not. Yeah, this one is a good one. It's not specific to marketplaces. So let's say that here are the cycles you go through when you're fundraising. So first you have your idea, you go to the fool's friends and family money, the love money. It's like 0 to 250K. Valuations vary. In fact, significantly enough, it's really not worth mentioning what it is. It depends what you can negotiate with friends and family. Pre-seed round, where you're raising the $1 million I just discussed, so 750K, $1 million. The average is 3 to 5 pre. And you're either so you have a team. You may have an MVP, maybe you don't have an MVP, and you're going to be building it. And the idea, especially for the first few rounds, is it gets you to the next round. So the idea is with that, in the case of marketplace, you get a seed round. A seed round probably means you have 10 to 50K in net revenues. And by net revenues, if you're a marketplace, let's say doing 150K a month and you take 20%, that's 30K. That's the 30K net revenue. So the average marketplace these days that takes 20% at seed would be doing 150K a month in GMV. They're raising at the average is probably 3 and 9 pre, but it's a range. It's 2 to 4 raise at 6 to 12. And it's a pretty big range because it depends. If you're a second time founder, you're going to command a higher price. If you're growing quicker than the norm, you're going to command a higher price. If you're particularly hot for whatever reason, you're going to command a higher price. The idea is with that seed, you get to a Series A. Now, there's also a time expectation here. The idea is you go from C to Series A in 18 months. And that 18-month matters because we're kind of expecting you to quadruple in size in that
And
time
not
period.
everybody hits that. Every founder says, and this is going to be followed by my Series A. And
no, of course, many companies don't raise the Series A.
Right.
Yeah, no, if I look at it, like the 5-year survival rate of startup is about 7%. So in the US, every year, there are 5,000 seed fund or startups that raise at least 500,000. Of these that raise a Series A, it's actually only 25%. That's the market at large. And of those that don't raise a Series A, like 95% fail. Of the 25% that raise a Series A, about 40% raise a Series B, and of the 60% that don't raise a Series B, about like 50% fail. So obviously, as you reach scale, you're more likely to reach profitability. You have lower failure rates. But if you walk this through all the way to the end for 5 years, you're at a 7% survival rate. So yes, most companies actually don't make it to the next round, but the expectation is not that you're going to be profitable from pre-C to C or C to A or frankly A to B. The idea is that you make it to the next round, frankly, until you get to the scale where you can become profitable. And that's like B onwards. And then you have a arbitrage of like further growth versus profitability depending on the potential in the market. But let's say at A, these days you're raising 5 to 10 and 15 to 30 pre, and you're doing, let's say if you're a marketplace, you're doing 650K a month, in GMV. So that's maybe 50 to 250K a month in net revenues. If you're a SaaS business, I'd use these numbers as the net revenue number. Your MRR would be your net revenue number here, and you'd command these types of prices. Now,
Well,
for the
let me make sure
very
I
best,
get so what is net revenue / MRR going
well,
when
the problem
Series
is
A
like
is happening?
the problem is like looking at company. It's trying to compare companies in an apples to apples basis, right? Like for a Series A company in the US, let's say you're a marketplace, I'll make the math really easy. You do a million a month in GMV and you take 10%. Your net revenue your actual revenue is 100K. And on that, you have a margin. Typically in a marketplace, it's maybe 75% margin. So maybe you have 70K net margin on 100K net revenue on a million in GMV. The thing is, if you're a SaaS business, you charge a monthly subscription fee. The equivalent of that million a month in sales, GMV for a company that takes 10% would probably be 80 or 90K in monthly revenues because you have a 95% margin on that. And so the net revenue numbers are probably the better ones to compare if you're trying to do it across categories. Of course, I have a specific valuation matrix in my mind for different verticals, but as I made one that's across all different industries to share with the public, I thought maybe it would make sense to do it a net revenue number more than anything else. Like if
Oh
there's
yeah.
an e-commerce company out there that's doing 200K a month in revenues, how do you compare that? How do you think about that from valuation perspective? And by the way, many businesses have multiple components. They have a SaaS business and they have a non-SaaS, and they have a transactional business with different margin structure. And I put different multiples and different valuations in both of those.
Which is absolutely correct. It annoys the hell out of me when some entrepreneur is banging on about their GMV revenues and trying to drive a valuation, and I'm like, I'm asking you to tell me the net revenue.
Exactly.
And they're actually dodging the question. Like, we're going to get to the bottom of this thing, and Also classically, you see a lot of companies are a services business that might not even attract venture financing, and now they make a product and they're trying to mix in the revenues of the old
Exactly.
business and the new product. And you just got to be upfront about that and show
Exactly.
people where you're getting to.
I
And
look, I'm going to look at independent unit economics for different business lines and the different margin structure. And I'm not blending everything together.
it's not only for valuation. You need to know that to understand the capital requirements for the business,
Absolutely.
right?
Absolutely.
And if your primary thing you're doing is sending them to Mike Maples at Floodgate, or somebody, Josh Kupperman at First Round, you got to know when to send it to Maples and when to send it to Kupperman.
Exactly.
So this is key. This is key. And also, so these funds with Nortel and now these other corporates, these are 2 and 20 vehicles, or is
Yeah,
FJLab
normal 220 vehicles. Yeah, normal 220 vehicles. And so far we've done really well. I mean, like our first fund, which is a 26 official institutional fund, which is 2016 with the 1 LP, I think we've already distributed over half the capital. I mean, and implied, which is probably top decile or whatever of the 2016 vintage funds.
Yeah, especially for the stage you're
doing
investing
really
at,
well.
because at that stage,
Yeah.
it can take, like, the early hits are often acqui-hire team by tuck-ins, where a lot of the
Exactly.
economics, I mean, you would know it if anybody. A lot of the economics on those exits are going to the founders, and
Correct.
you almost like, what? I thought the investor, I thought the dark side was the evil venture capitalist, whereas you literally see, we're supporting him, the amount of time you could put into them, and then they get sign-on bonuses. They get negotiated, or else they're not going to buy them, and they want the founders.
Yeah.
When it's at that
Yeah.
stage. When it's at that stage, but it's
because exactly an acqui-hire, they don't want the VCs, they want the founders.
full.
Yeah, I know.
On,
So what happens is we do a lot of secondaries on the way up. When we think, because we own small percentages, there's no negative signaling if we exit, and if we see that a company is doing, like if we're going to be a 10x after a year or two, the valuation we think is ahead of where it should be, we typically sell 50%, and that's why our that's why our IRR is so high, frankly.
That's why your
the magic
DPI. That's why your DPI is as good as it is. You're distributed,
and that's why our IRR is also high, because we distribute very quickly. Like we start getting exits very quickly, and which leads to high DPI and high IRR, because you start to get capital and exits very quickly. Now, typically our philosophy is when we choose to sell, we try to sell 50%. This way we play the upside of the rest, if it does really well, and we've sold 50% in that round. And by the way, because we look at each follow-on independently, it may very well be that we sell in the B and we buy in the C, right? Like if we think the B valuation is way ahead of traction, but then the C,
I see what you're saying.
The C on a risk-adjusted basis is because the decision to sell. First of all, we are not the sellers. I mean, it doesn't work that way. The very best companies, the VCs around the table say, "We would like more ownership. Would you like to sell?" Right. So it's never driven by us. It's never us saying, "Oh," because otherwise, obviously, we'd love to sell the companies that are not doing well. That never happens. It's always the companies that are doing the best where there are secondary opportunities. There's a founder is raising, he's doing really well. Sequoia, Greylock, and Andreessen all want to invest. They all want 15% minimum because of their fund rules. The founder doesn't want 45% dilution. He says, I'll take 30% dilution by early stage investors. So they actually come to us and ask us a favor to buy our position. And we do an evaluation. What do we think, given what we know? Should we be investing? Should we be doubling down, or should we be selling? And often the very best companies, the Flexports, the Rappies, those companies, we actually sell 50% on the way up, because it makes sense on a risk-adjusted basis for us, and also because it's so much personal capital that we need to recycle, because we need to keep investing every year. Most of our returns come from our own money, not from the fees. I mean, the fees on the fee-based side, we're barely break even now, and that's after, like, I don't know, 5 years of running a fund and like 22 years of investing, where cost structure is like 4 or 5 million a year, and for the longest time we had 2 million in fees a year or whatever, nothing. So we were subsidizing the structure.
I think it's interesting. So Fabrice, I think that you really have maintained the perspective of an angel investing your own personal capital throughout your journey here. And a lot of VCs, including me, like, chapter 10 of my first book was The Ladder to Liquidity, where I was making the case for founder liquidity and even early angel investor who can recycle and
Yep.
all those things. When even still, I find New York to be pretty hostile towards secondaries compared to the Valley,
Yeah.
where people want to see the founder get secured with their life, so they don't sell early and they go for that big. They're getting aligned, for the exit. But when you're investing other people's money to sell too early, we've thought 20% when it's really high, and then don't hit 50. And the truth is, I've had trouble doing it because I just want my definitive numbers to not be dampened at all. But if you're really investing a lot of your own money, I could see you're like, hey man, I got to recycle some money out. There's another thing just to clarify. What I want to make sure all of our listeners here understood is that so if you take a big investment, you make a big bet, risky early. Now Andreessen and everybody wants in, and you're selling 50%, and then you double down in the next one. Somebody might have gotten lost there, but it makes sense to me, listening to you explain it, that they might have gotten a valuation that was just spicy, and they haven't grown into that valuation yet. Like literally, investors are saying, look, this is crazy to be investing at a 250 million pre on a company that just went from 1 to 8 million in revenue, but we believe it'll grow into it. And so if you're selling 50% at that moment, and then later they do a more sensible priced round with your expertise of slicing the different types of revenue from net revenue to SaaS revenue, you're like, hey, this is actually a bargain at 500 million. Considering
Exactly.
how
Like
far
if they quadruple the business or whatever, quintupled, and they grew into the numbers, the next round is marginally more expensive. We do it. It's kind of like the YC strategy we have. Like it's a different story, but in Y Combinator, the valuations are really high. And so what we've often been doing is we go there, we identify the companies we really like, we don't invest in YC, but we follow up 9 months later before they raise the next round, and maybe they want a seed extension, and we'll invest essentially at like maybe the YC pre-money on nothing was 12 or 15, and the next round will be at 14, but with real traction. And half the companies died or pivoted or whatever, and so we don't do those. And so on a risk-adjusted basis, you're better off paying 20% more 9 months later than paying the crazy YC price before there's anything proven.
Yeah, I'm looking for a slide I've got that I made that shows when companies are overvalued and when they're not. Here, make me the host again, if you would.
Yep, I'll do that right now.
So can you see the screen there?
Yep.
So basically, if in the beginning it shows angel pre-seed, if you're low, that's good. If you're high, you're overpaying. So we think if you come in like Ron Conway, Rightside Capital Management, and FJ Labs saying, I'm ready to write a check after 2 calls, you're probably getting a good deal, but you better be good at this and get to a certain level of diversification. At the demo day of like Y Combinator, people were investing during. Every Russian is logged in on these things now with COVID. You are really paying a premium. If you're following up with those companies, and maybe you have to know that the CEO network likes you, that you're writing checks like you are, you can track them. And then in the late seed, which is what a Series A used to be.
Yep.
Because the funds got supersized. So a Series A, like a late seed, has got 100K MRR, 1.2 million ARR, a pipeline that can be qualified that's tipping. You're actually getting good value for money through to the Series A. By the time you get to Series B, it starts to look like a lot of people all of a sudden want to be in this deal. And there's a lot of good
There's a lot of money in the late stage these days.
Yeah, I mean, yeah, and they probably had people at the demo day. They've been tracking that company too. They're on PitchBook looking at all this stuff. And then of course you've got these people that are like SPVs out of Chicago that want to get a little SpaceX.
Yep.
And then that goes into you're really overpaying, to get in late. And my last thing is that what happens when there's an economic shift. And what you see here is that historically, people want to invest even later stage. And then, of course, the IPO is going to be a lower price than that last secondary or late stage growth. Let me stop sharing. So that's a little bit of my perspective, our perspective on.
No, totally agree. I mean, look, it's better to be in the seed extension than to be in the seed very often. the more is proven, you pay barely more. Now, of course, with that philosophy, though, you miss the very best deals. The very, very best deals, like their A is going to look like a B. Their C might look like an A. I mean, the ones that are like completely crushing it. But frankly, that's okay. I play Moneyball. I don't play Powerball. I'm not looking at the lottery ticket. The company is doing 1,000x. We've actually made money in 50% of the exits we've had. So, which is, given how early we invest, is rather exceptional. And that's because of a really strong focus on unit economics.
Right. And so, some closing questions for you. You have more experience than most people I talk to on launching classifieds in Pakistan or classifieds in Russia
Yep.
and Brazil in the same year, even. What's your experience on heart transplant failure or success? So, like, when something works in one country, doesn't mean like Superhuman is a great investment
Yeah.
that I was in very early, and it shows like, oh my God, my best deals are when I'm early, and it confuses all your plans on portfolio construction. But it would never work in China because Gmail is blocked and they don't even use email. They're all using WeChat. So some things are very clear would not work. Tell us about some of your experience of knowing when something does or doesn't work in another country. Like if the CPMs are really low in Pakistan, are confiant from New York, doesn't even come into unit economics of being worth paying for.
Sure.
Whereas in Japan, we're taking them to Japan.
Yeah, so most things that'll work in the US will work in most other countries. And if a category is large enough and interesting enough, it's good actually to fundamentally humans are kind of the same everywhere. We want to be entertained, we want to communicate and socialize, we want to have a sense of meaning and purpose in our life. And so to the extent that ideas fulfill those needs, they're going to be successful kind of everywhere. And you see in everywhere around the world, you have a classified site. Everywhere around the world, you have a social network. Everywhere around the world, you have a big e-commerce site, or in marketplace companies and food delivery, et cetera. So the categories are kind of the same, and the names may change. It may be different companies. And by the way, the approaches may also very much change because of the regulatory environment, the payment infrastructure, et cetera. But like the large ideas are commonly true everywhere. And so in the US, you can actually even do the opposite. You can take ideas that work in the rest of the world, bring them to the US, except you need to be more careful there, because if you're taking ideas from markets where cost of labor is really low, the unit economics may not work in the US, or the CACs are really low because the CPMs are very low in emerging markets in a way they're not in the US. The same may not be true. So it's harder to bring ideas, though there are some that would work from China to the US or Europe to the US, though it's less common. But US to the rest of the world, I think, is a very common idea that works, and that people should, that if you're ideating is a very valid model of ideation. I think there are 4 ways I come up with business ideas. This is one of them. And now, in general, I'd rather invest in the US than the rest of the world. But in the rest of the world, a copy of a US idea, great. I mean, adaptation is probably the better word than copy. The question is, when is the right time? And also, some ideas, the best player to do them is the US player, because they have the global network effects. Though that's not true of most companies, by the way. Most companies have national network effects, but not global network effects. And so it doesn't actually, and by the way, my main recommendation to US companies is do not go global. The 5%, the distraction of opening an office in London, it's going to take your eye off the ball in the US, and the upside scenario is not worth it. Like if you're at 100 million in the US, it's easier to go from 100 million to 200 million in the US than 0 to 100 anywhere else. It's true at a billion, it's true at 10 billion. Maybe there's a point where you're hitting like an inflection curve, like a logarithmic growth, and it's no longer true. And at that point, either buy or go international. But for the most part, do not go abroad. Like if Uber could have a do-over and just win the US and make sure Lyft doesn't exist, or kill them, or buy them, and not do the rest of the world, they'd probably be in a better position and stronger position than they are today, with all the distraction that they took by going and fighting in all these territories and all the burn and dilution it entailed. And the exception to that rule is if you're using user-generated content. If you're Facebook, go global. If you're Instagram, go global. If you're Wikipedia, or in our case, OLX, go global. But if you have like supply chains,
Regulatory
inventory,
battles like Uber.
payment, regulatory rules, etc. I frankly don't go global. When the US, it's a big enough market and you're going to be happy. Now, if you're a founder in the rest of the world, yeah. At what point is the right time to look at the breakouts? Hard to tell. For us, it used to be unless something reached like 100 million value or revenues, we wouldn't look at it. Maybe there's a way to identify the real breakouts earlier to see if we should do them in the rest of the world. Not a core focus for us, to be honest. So I don't spend that much time thinking about it. But yes, things that work in one country will typically work in other countries.
And Fabrice, closing question, I'll let you go. Tell us about this podcast or this streaming show of yours. COVID has now got you to do everything you've been procrastinating about for the last many years, I'm sure.
Yeah, first of all, it's exactly that. All the things I've been needing to do, like redesign my blog, write more, read more, create this live streaming show. So I thought long and hard about like, if I was 23-year-old me starting my very first venture-backed company, what is it that I would like to know? And is there a way to get it out there? And I'm like, I love all the podcasts that people are creating. It's giving a really good sense of people's journeys and stories and lessons learned. But distilling the information in an effective way is not really well done. And on YouTube, I think the quality, it's high production values but low quality content. So I'm like, okay, can I create a show where every week I create a piece of content specific on one topic on something I wish I knew when I was a founder when I founded my first venture-backed companies 22 years ago. And it's everything from like, how do I come up with a startup idea? How do I evaluate if the startup idea is any good? How do I do landing page analysis? How do I pick the right business model? How do I fundraise? What are the current theses or trends in the market right now? And it's not the traditional live streaming show or podcast of like having a guest come and talk about their life experiences. It may have its guests maybe to speak about a specific topic, like the history of venture capital and how venture capital works, as opposed to their story.
Yeah, so it sounds like I've written 3 books, and I think it's important to, and we've spoken about this before, that it's important to design the book and have like a really good outline. And for me, I've learned to suppress the urge to start writing full sentences and just keep that outline going for years.
Exactly.
So as I bump into something, information rights, if I had them, I might be able to do a secondary. I can't do a secondary without information rights. And what founder thinks he's got to negotiate permanent information rights in a Series A, he'll never get fired and alienated from the company. So like little nuggets, if you let time go by, just put it on the outline. It sounds like rather than have these sort of unplanned, accidental podcast conversations, if you premeditate and map out, this is what the founder needs to go through, and especially for your market. And it even helps with your brand. If they're like, my God, this guy really knows marketplaces, like down to the level of landing page discussion for 40 minutes or something.
How to build an MVP for 20K, right? Like that was one of the topics. And I'm trying to target not just marketplace founders, but like aspiring and existing startup CEOs. So again, it's not for everyone. It's not for if you want to build your SMB. It's really if you want to build a venture-backed company. Everything you should know, I think, because I don't think there's a resource for that out there. If it frankly should really be a YouTube series rather than a live streaming show, but it requires production values and amount of time and money I'm not willing to dedicate to it. So by forcing myself to do a weekly show, it's like forcing me to create the content for that week, and it's a forcing function to crystallize my thinking. And it's Playing with Unicorns is every Thursday at noon on every streaming channel. Probably easiest to watch it either on YouTube or Twitch.
Okay, and I'll include something in the show notes. Send me something so I can give people details on how to check that out.